Hello, everyone, and welcome to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. First and foremost, let's cover our disclosure disclaimer agreement. Main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. It's always available on our website. Please feel free to read that in detail at your leisure there, or take a screenshot now if you like. But that's the main point to take away. Other than that, the market's pausing from the rally the past few days and seems to be waiting on the Fed meeting tomorrow and the decision that comes out of that. So let's get right into it. Rob, you out there?
Hey, I'm Zach. Happy Tuesday afternoon to you. Welcome to TradeFinder, everyone. And we'll just jump right into the markets. As you can take a look at the chart, you can see that we have bounced back down from the move up. We did go to 570 yesterday, which is what I was talking about yesterday during our Evo Trader Live show for our alert subscribers, that I thought we would at least test. We weren't there yesterday when we were doing the show, but then into the afternoon, we did go up and hit that 570 level. That was support going back into September, October, and November. So it's likely that it's going to be tested as resistance now. What was support becomes resistance, you know the drill. And so we're backing off a little bit. But as Zach mentioned, we have the start of a two-day Fed meeting today. I don't know why. They every other month they do these two-day meetings, and you just wonder what can they talk about for that much time. But the actual conference and any movement comes on Wednesdays, and that'll be at 2:00 tomorrow afternoon. Nobody expects anything as far as a move, but perhaps they give some sort of a hint on whether or not they're going to look to cut a little bit sooner. As I mentioned in the U.S. market update over the weekend, hopefully everybody's looked at that by now. There is now a 25% chance of a 25 basis point rate cut in June. I think that's really optimistic. I think the Fed is really pretty comfortable with where things are. They want to wait and see. The tariff policies are supposed to go into effect, and there was news out today. They are going into effect on April 2nd, and the Fed wants to see a little bit of data for that. So I even think September could be a slight bit optimistic, but much higher percentage chance on the Fed fund futures that we see a cut in September. But I think the June one is just a little optimistic. So we did bounce off of the lows here. We had a pretty vertical move to the downside. When I put the moving averages on, you can see that we bounced up, got above the 10-day moving average, closed right on it, tested 570. All this is very classic as far as what to expect to happen. And then we bounced down a little bit today. And maybe it's just, okay, we bounced up and now we're going to pause. I still think there's a good chance we see 540 tested, because that's the next level of support. And where we bounced here is kind of in the middle of no man's land between 570 and 540. So this little bit of a bounce here was warranted. We'd gotten a little far from the 10-day moving average on the low. You know the rule, no security in any time frame gets too far away from the 10-day moving average for too long. I have to add that in because some of you all say, oh, well, there's separation. But it doesn't last that long. And now we've bounced back down. So do we continue lower down to 540? Can we continue this bounce? We'll have to wait and see. What's really interesting is something that the software can do. If you're not aware, I know a lot of you have been using it. You've been posting comments on the YouTube videos that you're using this hub software and really like it. For those of you that may be new, we had a lot of new viewers on the U.S. market update this past weekend. Go to hubb.com. Again, hubb.com, and get a copy of this software. You get live Elliott Wave, free Elliott Wave. And as I said, you can put it on pardon me, live charts as well and watch it move throughout the day. So if I switch over here, I'll show you a couple things real quick. We move to a 3-minute chart, which is what I like to watch. And one thing I want to show you, which I'm going to expand on here in a second, is I use 377 data points. You can change that in the programming as far as how much data the algorithm looks at to give an Elliott Wave count. 377 is in the summation series. The Fibonacci summation series is 1, 1, 2, 3, 5, 8, 13, 21, etc. If you wonder why is it called a summation series, you add the previous two numbers and you get the next. So adding summation. And then if you go up far enough, you'll get to 377. So it's in the Fib summation series. That's why I use that. So here what we can do is condense the chart and tell the platform to get more data. Now that went away, and we still don't have a 5-wave pattern. Nothing as far as a 5-day pattern intraday. So the market is in corrective mode. If you're not in an impulsive 5-wave pattern, you're in correction mode. So a flat zigzag or triangle. Could this be a zigzag to the downside? Well, another thing you can do if you're troubled by the fact that you're not labeling in a 5-wave pattern, you can come up here and click on this little gear for Elliott Wave and change that data point from 377. So let's go to 100. And basically, you're now telling the algorithm within the software, just look at the last 100 data points. So if we're on a daily chart, each bar is 1 day. So it's telling the algorithm, just examine what's happened over the last 100 days. And then that does give us an Elliott Wave impulse labeling, 5-wave pattern labeling. But note the wave 3 is still green. So even on this bounce, it hasn't labeled the wave 4 yet. It might. That might be the only bounce that we get. And then we move down towards that 540 level. We'll have to see over the next couple of days. But to me, that makes a lot of sense. And this is almost too well set up that you go a little too far on the downside and then you bounce up right back to resistance and then turn and head down to the next support. That would be classic textbook stuff. And the market doesn't always give you exactly what's expected. Whatever the Fed says tomorrow could change things, but that's how it looks right now. So if you're just determined that you want to see a 5-wave pattern on your chart, that's a way to do it. Just shorten the amount of time that the algorithm looks at, which shows you the flexibility on the platform. And Zach will be on later to give you a quick idea of how to post an idea on the social media aspect of the platform. So it does way more than just technical stuff. And if you have a favorite indicator in addition to Elliott Wave, we can add those on the chart too. Every indicator that I know that exists is included here. I just over here on the left-hand side have the ones that I look at. So that's under favorites. You can put your own favorite indicator in there, and so you don't have to click on all the studies or tools or whatever and go through all that every time because there's a massive list of them. Again, everything that exists is there. Just highlight the ones that you use most often. We'll watch and see what happens. I would assume the Fed isn't going to give us anything tomorrow. It's going to be pretty much status quo. They're comfortable with where things are. They're going to wait and see. Retail sales yesterday came in weaker than expected, but better than January. At least it was positive. It was up by 0.2, where we were down 1.2% in January. So consumers are spending, but not as much. They've pulled way back on their spending, and the ex-autos number was right in line with expectations. So the consumer is spending, but not on new cars, is really what you get from that. Used cars, pretty good place maybe to look as people will try to save money. The consumer may be buying used cars instead of new cars. And then the home builder sentiment came in and it was really bad again. So the builders are like, things have really dried up. And that's the way it always works in the housing market, is that you get a big run. We go through these periods where there's great demand and the builders build, and then they tend to overbuild. That's always how psychology works. You go from one extreme to the other. So they build too much. There's too much supply. Demand meets supply, and things come to a halt. And that's what's occurring now. Maybe that will help to bring home prices down, which need to come down because they're exorbitantly high. higher than what the average consumer can afford. One other thing I want to point out here is when you look at this, you can see the 10-day moving average has separated pretty greatly from the 50-day. That works exactly the same as the rule. No security in any time frame gets too far from the 10-day moving average. These two tend to notice here how we kind of stay in some sort of symmetry between the 10 and the 50-day. And when they start to separate, it's likely that we need to have a period of time to allow the 10-day and the 50-day to catch up. Now, whether that's the market moving sideways and the 10-day moving average moves sideways a bit and the 50-day comes down, or we bounce a little bit more, maybe we need to go a little higher and create the wave 4. I just think that this bounce down from 570 makes a lot of sense. And so we will see those two come closer together, or it could be some combination of the two, maybe sideways to a little bit of a bounce, and let this 50-day come back. But we're definitely still slightly in oversold mode, and we await the Fed to see what's happening. One thing I wanted to show you is over here, for those of you that have the software and have subscribed to the AI signals. Now, when you get the software's free, Elliott Wave's free, Live Elliott Wave's free. But there is a subscription for the AI signals, which brings in an AI scoring of directional type moves. And if you look here, you can see on the bullish side, you look at Allstate, and it has a 69% rating. We really like to send out alerts at ewotrader.com on ratings of 75 or above. I have done 70, so 69 is a tad low. But I kind of like the fact that this is an insurance company in Allstate. Tends to be a bit of a defensive sector when the market's weakening. That's where money goes. People still have to have insurance. All right, you've got to have auto insurance. It's a requirement, or you can't get your tag renewed. So people still, no matter what the economy is doing or what their incomes are doing, which incomes are still staying okay, they have to have their insurance. So this is really interesting to me, even though the score is only 69. So I kind of like that one a lot. It's ticking down a little bit today with the market, but in addition to that, on the high yesterday, it had a little separation from the 10-day moving average. And look how Allstate has just stayed right in concert with that 10-day moving average, which is the lime green line. So this is a decent separation for Allstate. So a little bit of a pullback today might provide a pretty good entry. But we're going to probably look at something different for our case study consideration today. Another interesting thing is that when you go to the bearish side, there's no bearish score. So just this 3-day bounce that has occurred in the market was enough to, we had a pretty long list of bearish signals, none of them high enough to give us scores to put on bearish trades yet, but there was a lot of them that were showing up on this move down. So this tells you once again that the AI is saying, we're probably not ready to go back to that downside, maybe that 540 level. So maybe we do need a little bit more of a bounce. Again, the 10, 50-day separation kind of ties that in. And something else I wanted to talk about as far as the AI is tomorrow night doing an event. It's free. It's called AI Fusion. And basically what it's going to be is what the AI is looking at for the rest of March and moving forward. We did an AI event back in January for the AI outlook for the year. So we'll do a bit of an update on that. And again, talk about more of the shorter term as well. So it'll be at 8 p.m. tomorrow night. You can see the link on your screen. Register. As I said, it's free. So join us and we'll talk all things AI as far as the shorter term and an update on the longer term forecast. So it's going to be a fun event. Love to have you join us. If you register and can't make the live event, don't worry. There'll be a recording that you can watch at your leisure. So if 8 p.m. tomorrow night doesn't work for you to watch it live, you'll be able to watch the recording. So that pretty much covers everything on the S&P. If we take a look at the VIX real quick, we have come back down. I've been speculating about this unusual move in the VIX. Some of you commented about that on the U.S. market update. Just this trending move in the VIX is unusual here, especially with these large bars, meaning that there's a lot of intraday volatility, but yet still climbing higher. And note that the highs got up near 30, which exceeded this spike high back in December. But normally, when you get these moves in the VIX, they are these spikes up. And then you get the retracement back down into this range where we've been for so long, between 12.5 and 17.5. And then we moved up. If you count those highs from October and November, we got a little bit above it there in December, and we got above it again here. But it was different because this was a trending move up in the VIX rather than these big spikes. Is that enough? The VIX has come back down. It's back in the range. Does it stay there? So this is unusual. So one of the fun things about, I've been trading for going on 28 years now, used to trade the VIX when it was on the OEX. It's far harder to trade the VIX now on the SPX, but used to be a great trading vehicle on its own back in those days when it was on the OEX. But it's unusual to see this kind of a move here. So it's something new. And that's what's fun about trading, is no matter how long you've been doing it, you always see things you haven't seen before. You will never hear me say, I got 28 years experience, I've seen it all. And anyone that says that is just daring the market to show them something they've never seen before. So I don't see that or say that, but that's what's interesting now. We'll see. It still feels to me like we need to have one of those big blow-off spikes in the VIX to really wash things out to the downside before we get a sustainable bounce. And that's likely not going to happen until we start moving closer to rate cuts. If the Fed were to say, for some reason, we are considering June, I think the market would react to the upside on that. I don't expect that to happen. That would be a little bit of a surprise. Again, it's only a 25% chance in the Fed fund futures. And by the way, the Fed doesn't produce the Fed fund futures. That's an independent group that tracks that. And there's a market watch indicator that tracks that as well. So the Fed isn't predicting their own moves. That doesn't even make sense. Why would they do that? They're not going to do that. But if the Fed came out and said, hey, we're considering June, I think that would even be enough to propel the markets to the upside and bring the VIX down. And maybe we don't have to have that big spike in the VIX. I think that's all going to be interesting to see. Moving to the bond market, we come over here and look at TLT, and this is very constructive. It's helped to calm the equities market. So we were up 3 days in a row and probably aren't going to finish up 4 days in a row. As we pause, as Zach alluded to in the opening before that Fed meeting tomorrow. But if you're newer to Elliott Wave, you can look at this chart of the TLT and see how spot on it's been on Elliott Wave rules. So we had a zigzag within the wave 3, which I love. It's one of the things that we do in our impulse strategy, which is AI based at ewotrader.com. Then we bounced up to 50% on the wave 4, went right to 100% extension, which is what happens a high percentage of the time. And then we bounced. And when you bounce, when a wave 5 completes, you go through a corrective phase, which is either flat, zigzag, or triangle. So one of those 3 patterns occurs when a wave 5 ends. And we formed a triangle, and we broke out and formed another triangle. So, I mean, it's just as classic as it can get on the TLT within Elliott Wave. I think if Elliott were still here today, that would go in a book or something saying, here's a perfect illustration of Elliott Wave. 1, 2, 3, 4, 5, complex wave 3, strongest of all waves, wave 5 goes down. I mean, this is just absolutely amazing as far as following the Elliott Wave rules. So we take that off, and then we go up here and look at TNX, because I know you guys like to look at that. I used to look at the TNX most of the time on the 10-year, but the 20-year kind of gives you a little bit of a split between the shorter end and longer end of the yield curve. And on the TNX, being the 10-year, this is rates. TLT is on prices. Prices and rates move inversely. So on TLT, we come down and moved up. And then on TNX, it's rates. So it's showing you how rates have dropped as the prices on TLT went up. So you can see that this separation here is exactly the same, except this is still labeling in a 5-wave pattern. And this is where I'm really concerned about the market. This chart is of any chart looking at the market, this is the one that's most concerning if this were to play out. In other words, that we do bounce from here and go up to the wave 5 on rates. To have rates move that far with clear economic weakening, there's a debate about whether or not we're going to have a classic definition of a recession, which is 2 quarters in a row of negative GDP. That next GDP report's really going to be watched. If we get the economy continuing to weaken, and this was to sprint up in this wave 5, so we get rates moving up and the economy moving down, that's where that S word comes in, stagflation. A lot of the talking heads are saying, you got to look at it. It's a possibility. We don't think it's going to happen. But that's the worst of all worlds. And the reason for that is, what does the Fed do in that environment? Do they cut rates to help the economy? But that could spur inflation and drive rates even higher. Or do they raise rates to try to bring rates and inflation down? And that, I know it sounds counterintuitive. Why would raising rates bring rates down? Well, it's step 1, bring inflation down, and then rates will follow. So it works on the inflation side of things first. But then that is very detrimental to the equities market, and we would have to sustain some more downside discomfort in the equities markets. We're not there yet. As you can see, we're just here consolidating, and the bond market is being quiet. But all of this quietness, these 2 consecutive triangles, both on the TNX and the TLT, mean that something's going to happen in the bond market. Now, if it breaks down to the downside, maybe that helps to move the equities markets higher. So we're just going to have to wait and see and get the cues from the bond market. This is a bit of a wait and see type of environment, not just on the Fed tomorrow, but what's going to happen in the bond market. And I've always said you don't have to be an expert bond trader to be a good equities trader or derivatives trader, which is options, which is what we do at Evo Trader. But you should have at least a basic working knowledge of the bond market, because normally the bond market leads the equities market. There's more money, it's more liquid in the bond market, and it's viewed as a lot of really smart people are on the bond side of things. So you have to pay attention to what's going on in the bond market. But right now, it's just kind of sit on your hands and wait and see. And the AI is kind of telling us that as well, with not giving a whole lot of directional signals. So we wait and you don't force directional trades. You wait until the pattern's set up, and then you pounce and you take advantage of them then. And then when you're in an in-between phase, you do other things. You do sideways trades. We like to do strangles on these triangle type formations. Good examples here in the bond market. And let the market break out. And with a strangle, you don't care what direction it moves. Let's move on to the Dow with the DIA. And you're going to see similar patterns here. The wave 5 finished here. And we had a little bit of an expanding triangle. We had the breakdown. 420 was the same as 570 was to the SPY. So that was support. We broke that. We tested that yesterday as well. I find that really interesting that the SPX, or the SPY went right to 570 on its test, and the Dow went right to 420, at least the DIA on its test. So both of the markets moving in concert between the S&P and the Dow right now really, really nicely. When we move to the Qs, we find an outlier, though, not quite the same exact thing. 500 is that level. You can see we didn't even come close to testing that yesterday. And the next support is down at 450. We still have a 5-wave to the upside pattern qualified on the Qs. If the bond market breaks down, in other words, yields go down, maybe that could spur a move up. Maybe NVIDIA's conference today. NVIDIA has that big tech conference today, and there's a lot of bigwigs there as far as that kind of sector. Maybe that can turn things around. As you know, NVIDIA has been hit pretty hard in all this as well. Are the Qs the leader, or are the Qs lagging and haven't caught up with where the SPY and the DIA are? That's going to be interesting to find out. Something's going to change because the major markets will get at least with some sort of similarity. They don't have to have the exact pattern, but they are usually a little bit more similar than where this is. And then if we move to the small caps, they're really screaming for rates to come down because rates moving up is not a good thing for the IWM. If that TNX does start to move up in that wave 5, we're going to see a breakdown of the IWM, and we'll go to the next level. Notice that we went, again, Elliott Wave stuff on display here. Here's the A wave of the zigzag, B wave right to 50%. You'll expect the C wave to go to 100%, and look what happened. Down, 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 boom, hit the 100%, dead sideways. That's why we look at this stuff. That's why we trade according to these things, because it works. Isn't it amazing that we come right to 100% and just dead stop on the downward move of the IWM? So we'll wait and see if we can mount a bounce here. It's all going to depend. The IWM is all going to be whatever goes on in the bond market. So if we break down in rates, maybe we get a bid underneath the IWM. But if we break up in rates, we're going lower on the IWM. Feel pretty confident about that. Moving to energy, if we look at UNG, kind of consolidating here versus its big move to the upside. And I think that's pretty norm. The wave 3 is still green, meaning that the algorithm is not quite sure we're done on the upside here of the wave 3 on UNG. But the fact that we consolidate, we got a little bit above the 10-day moving average here. Now we've corrected that. And going into a little small triangle right there. We'll see what happens with natural gas, as I've been talking about. So you've heard me say this before. Unless you're brand new, we waited for so long for a bid to come under natural gas, and it finally took these data centers being open that say they're going to be running on natural gas to give that bid under UNG. But now it's like, how long is it going to take to build them? How much natural gas are they going to use? We don't know the answer to those questions, but one could certainly surmise that all these data centers that are going to be built are not going to be built at the speed in which Elon built his. It's going to take time. So maybe some more consolidation here is warranted. But as long as we hold above 20, you say stay constructively long UNG. If we break that, well, then that changes things, because according to Elliott Wave rules, if we break below this B wave, then that means we're likely going to retrace that A wave impulse in the zigzag pattern, and we'll be back down to 1750. So watch the level of 20 if you're interested in natural gas. USO just kind of doing exactly what it should be doing, staying in this range. We tried to sneak out of this little symmetrical triangle. It's a small one, but Elliott always said, don't diss the small triangles. You know, we always focus on these big ones here like this, and you can see the big breakout in oil. But the little ones matter too. Yesterday looked like we might be sneaking out, and today right back down. So that was a false breakout. I just think oil is doing exactly what I thought you've heard me say for months now, that I feel like we're going to stay in this big trading range with oil. And that's because even though President Trump wants to drill, baby, drill and get domestic production up, he wants to bring the cost of oil down and therefore the prices at the pump. But OPEC has said, fine, go ahead. And they even used this phrase, drill, baby, drill. We're just going to cut production to meet whatever increases you have domestically. So I think that just holds oil in a range. As you know, OPEC is trying to walk that fine line. They want to keep oil price is elevated so they can make as much as they can with the supply they have left in the ground. But they don't want it to get too high to where it quelch demand, because if you shut off the demand and run everybody to electric vehicles, then obviously oil comes way down. They don't want that either. So they want to manage it. They want to kind of manage that supply demand balance there to where oil is high enough that they're making good money, but it's not so high that it's deterring demand. And so far they've managed that pretty well. If we go to the metals, gold just taken off again, and this big gap up today. We're starting to get to where at some point we're going to be a little bit overbought on GLD. You can see this symmetrical triangle here, and we're about to the point where we should be. On these triangles, you measure the high to the low. So we come down here, call that, 262 and the high 272, so a 10-point move. The point of the triangle is at 267, so that would get us to 277, and we're 279. That's why I'm thinking that maybe that's a little bit of a blow off top on GLD. Maybe that wave 3 will label as being complete, and we start to come back down. But this feels a little overdone now on GLD. We could get a little bit of a pullback, and then maybe the wave 5, if the economy begins to weaken a lot, maybe that could put another bid into gold as far as a flight to safety. We'll wait and see. But then we look at SLV, which is up near resistance. So it's at the point where it probably is going to find a little bit of resistance here. And we're right at this point of not only resistance, but being a little ways from the 10-day moving average. So slightly overbought on silver as well. The pattern looks the same, but the movements haven't been quite the same as GLD. Silver is still lagging a little bit, and maybe it's just that connection with the tech sector that's been hit so hard. But I do think at some point in time, we'll see silver outperform gold, but we're not there yet. We're not there at this point in time. All right, let's move over to crypto land, and struggling here with cryptos. Can't seem to renew that euphoria that we had after election, where we had that huge move up. The consolidation all the way through here was kind of normal, but then we broke down and we're consolidating into a triangle here. So all I can say is something's getting ready to happen with Bitcoin and the cryptos. But when you have a triangle, you don't know which way. And you can look at this and say, but you've got a wave 5 situation here set up. So Bitcoin is going to break to the upside. No, you don't say that. Even in the world of Elliott's writings, if you have a triangle, that is more important than the 5-wave pattern. You pay more attention to the fact that a triangle says you can break either way than you do the wave 5 setup. Now, maybe we break to the upside out of the triangle and we move up in the wave 5, but this setup here in a potential move up to the wave 5 does not mean that triangle is going to break higher. We have to wait and see what direction Bitcoin's going to go, and then that'll give us more of a cue at that point. Poor Ethereum. Gosh, don't know what else to say. Been lamenting on Ethereum for a while. It got a little bit of a bounce on the announcement a couple Sundays ago that it was going to be included in the strategic reserve, but it didn't get the bounce that the other cryptos did, and now it's back down here, and we're in no man's land. We're consolidating right under the 10-day moving average between 22.5, which was support that needed to hold, and it didn't. The next support level is 1,500. Maybe we need to go down there. The wave 3 to the downside is still active. It's still colored green, and that might be where we end up. And I don't even think we need Bitcoin to break down for Ethereum to go down there. Maybe they move in concert together, but I don't think that has to happen. Not sure what it's going to take to put a renewed bid in Ethereum with all those ETFs. Now it has all that buying and selling to balance out with the ETFs, and the investment management companies might have been the kiss of death for Ethereum, creating all those ETFs, and that could be what's occurred. You can see this big triangle back here. furthers my point that a descending triangle does not mean a downside breakout. It did here, but you can have upside breakouts out of a descending triangle as well. This one did go down, but any triangle can break either direction. And we're right at the point where we should be on the triangle breakout. So does that mean we don't go to 1500? I just feel like you just can't do anything on Ethereum right now. If we start to break down, you probably have a short to 1500. We start to break up, I don't think you go long until we're back above 2250 with a follow-through day. The one that everybody's been talking about for months now, XRP, which up till today had been really performing well. It's kind of breaking down here. It is in a 5-wave pattern to the downside, and the support's back down at $1.50. As I said, it's held in there pretty well. There you go. There's a descending triangle with an upward breakout, what I was just talking about. So descending triangle breaks to the upside. Then we go to a symmetrical triangle. We broke down there. So we broke out of that symmetrical triangle and tested the point of this previous triangle all in the same move. And then now we form this. This wave 4 is green, so we could get a little bit more bounce. It's not sure. The algorithm's not sure wave 4 is in yet, but we're ticking down today, and maybe that means a move down towards $1.50 here. We'll see. As I talked about last week or the week before, the forecast, because I wasn't sure of when the U.S. government was going to start acquiring these cryptos for the strategic reserve basket. It's going to be spread out over a number of years. So it's not going to be just a big one-time purchase that could spur these things on, but perhaps it can put a sustained bid under the cryptos and any shorts get washed out, and then we move higher from there. But that's a longer term thing. So I think some patience is going to be required no matter where you are in cryptos. Solana, which is at a point that's really important right now, it needs to hold here, but it's got another layer of support not too far below. So it's trying to hold right here, as you can see. But even if it breaks below here, it's got another layer of support right in this area. So it would take something really negative in crypto land to break this second support level, but we might need to move into this corridor here and go sideways through here. And then Cardano, the one that surprised everyone, had the biggest move on that Sunday a couple weeks ago when it was included in the basket. Not many people expected it to be, but it was. And so it had this massive break higher. But then it's back down and consolidating. Not the best triangle here because there's too much open space here. I like triangles more like this, where you have more touches of the line. This is far more indicative of a classic triangle setup. It is a triangle. We have higher lows, don't have so much on the lower high standpoint here. And so, you look at it and you watch it, but it's not as well formed as some other triangles may be. So that covers off energy, cryptos, the markets, etc. Let's go quickly to international markets. We'll see what's going on there. And then we'll open it up for questions, and then we'll have Zach come in at the end and show you how to post today's idea on our case study consideration. So the EWA labeled a wave 5. It's in this tap box. I was asked about that in the U.S. market update. It stands for time and price projection. So where you are on the width here, or the height, I guess it would be, the height of the tap box is giving you the price range. The width or the length of this gives you the time frame. I know there's a lot of believers, and you can set this tap box either way you want. You can set it to Fibonacci ratios, or you can set it to statistical probability if you like that better. And the way you do that, again, coming over to this cog here, and you go to the tap box, and right here you can see the time calculation and the price calculation. You can split them if you want. I think it makes more sense to have them both on the same, but there you can go to statistical probability if you'd rather have that than the Fibonacci levels. I'm a big Fibonacci guy, so I like to have it set on what the Fibonacci ratios say is likely to happen. But we're in an area, maybe we hold here. A little surprised we're moving down with gold moving up. Maybe that bounces back up later today when their markets open. But for now, we just kind of is the wave 5 done? If it is, then we will march back up towards that wave 4. But we have to respect with the fact that we're bouncing down from the 10-day moving average that perhaps that wave 5 moves a little bit lower in the tap box. So again, on Australia, wait just a little bit and you'll have a pretty clear signal of where to go. But as far as this point in time, I think it's just a guess of where things may go. And then the EWC with Canada, y'all heard the news, you know all the stuff that's going on between the US and Canada. I'm just really surprised that the ETF for Canada hasn't been weaker. It is in a wave 3 to the downside, but it's trying to hold right in here at the beginning of where this zigzag was. That goes way back there. That's why that 0% level there is. That's where that zigzag started. We're marching down again a wave 3. It's not sure it's over. We are trying to hold the 10-day moving average. Got a little bit of resistance from the 50-day. If we can break above the 50-day moving average, then maybe there's a bid coming underneath the EWC. But let's wait and see, since it's right between the 10 and the 50-day. If it breaks back down below the 10-day moving average, then this wave 3 probably extends lower. If it can get back above the 50-day moving average, then maybe you look for this 5-wave pattern to become disqualified, which would then mean we're moving back up here to the highs on the EWC. I know there's a big sense of nationalism in Canada. They don't like to comment about being the 51st state for the U.S., so they created a rare span of nationalism in Canada, and perhaps that's what's helping to hold that market in there. As we move over across the pond to Germany, which you know has just been defying all odds here. If you look at the economic reports, their last GDP report, etc., it's not been good for Germany, but yet we continue to go higher. Two things here. One, you've heard the expression, the market climbs a wall of worry, and that's because when sentiment gets really, really bearish, the market tends to go the other way. When you get extremes on sentiment, the market likely goes the opposite direction. And the reason for that is, one, the opposite direction is the path of least resistance. So if everybody's selling, it doesn't take many buyers to turn things and go back the other way. They can jump in early. So that kind of creates a little bit of movement in the opposite direction with the movement in the opposite direction. But you also get the fact that when you have sentiment all go one way, if everybody in this case is buying because it's too much to the upside, you're going to get to a point where who's left to buy? So that creates a movement to the downside. I kind of thought maybe that was it on Germany, but yet it's come and made another new high. We had this triangle here and we've amazingly outpaced that. I mean, just blown that target away, moving much higher than would have been expected. But it's going to come down to earth at some point in time. There's that separation between the 10 and the 50 days starting to occur on the EWG. I'd have a hard time going long that right now. We're going to get at least a corrective move at some point, and likely in the near future. I would think, on Germany. And then the INDA is getting a sustainable bounce. It had this little triangle down here. Now the wave 3 is labeled. So you can see it's turned purple. So the algorithm does think that 3 is done. This is the wave 4 bounce because we passed the 23.6% fib level. That's the first fib level. Wasn't Elliott's favorite. He didn't really trust it too much as far as being a corrective or impulsive move, but yet he believed enough in fib levels to put it into the algorithm. So when it hits 23.6, it will label it, But if you read his works, the number of times that is the final move, in a wave 4 here, for example, for it to turn and head back down happens a much smaller percentage of the time than this wave 4 continues higher up to, say, 38.2, which is a much stronger fib level. So perhaps the bounce in India continues. And we got into no man's land down here, but we did consolidate into the triangle, and we're getting the breakout. And the reason I say no man's land is we had a 50% B wave correction that yields 100% extension. We went there, but then we broke below it. And for those of you that have been watching for a while, on these zigzags, the C wave periodically will extend down to the 161.8% level. Normally, if it's going to do that, it will test the previous fib level, which would be right here at 61.8, and then it moves down. Maybe that's what's going on here, and maybe this 5-wave pattern stays in place, and we're going to see new lows in the INDA. You just have to wait and see here on the INDA as well, also slightly above the 10-day moving average. So maybe a little bit more of a bounce there, but it's not all clear on India by any way, shape, or form at this point in time. And then I thought I'd go ahead and add in China, because it's had to break out another descending triangle that broke to the upside. I was anxious to see what would happen when we got to this resistance area. And you can see we went sideways for a while, formed another little small triangle here. And we're getting the upside breakout there. So money moving into China. David Tepper was right. He was down in here saying that he's going long everything China. And he's a real smart guy, one of the few ones that I listen to. Let's hope he's smart enough, if you're a football fan, to fix the Carolina Panthers, which he now owns as well, because they're a nightmare. But as far as going long China, he was 100% correct there. So let's hope he's as decent in football as he has been on the markets. But yeah, we broke out above that resistance area in the wave 3 there. We'll see how far that can run. That one could go higher because there's nothing really to stop it. It's in clean air. I'm a big F1 fan, Formula One racing, go Red Bull. But if you're racing out in front, you have clean air coming into your engine. Your engine runs cooler. You would think runs better and more horsepower. If you're in the back of the pack, you got all that exhaust. You got hot air. You got all the little tablets coming off the tires. Engine runs hotter, tends not to perform as well, much harder to move from the back of the pack up to the front. So that's my racing analogy there. All right, was that Zach? Let's go ahead and take a couple of questions, and then I'll give out the case study for today, and we'll post that on the website here in a few minutes. But happy to take a couple questions now.
Sounds great. Let's get right into it. I just wanted to say real quick, with your racing analogy there, that's without the exclusion of DRS being enabled. Is that correct?
That would be correct.
Well, F1 right there.
Just a little added
right into there. Yeah, absolutely. Let's get right into it for a question from Ringo on STM.
STM. I haven't looked at this one in a while. You can see there's no lines. It was showing up on the AI stuff in the past, but I have to look at the options here because that's a pretty decent triangle right there. There's where you have more touches of that line on the lower highs. And you have the exact same setup here on the higher lows. This is going to break out. Again, can't tell you what direction. We finished a wave 5. What's it supposed to do? Flat zigzag or triangle. It picked the triangle. So it's in a corrective phase following the end of that wave 5, which did come down into the tap box here. See, this is the challenge that I've had. I've had way more success on the tap box on a price level than on time. And I know a lot of people have done a lot of work on Fibonacci time things, etc. It did hit the price level, which it does an amazingly high percentage of the time, just took a little bit longer. So if you've had the issues that I've had on being right more on price than time, if you're an options trader, you just pick options further out in time. And then you can counteract that and give it more time to work. And that's what I've done. But setting up here in this triangle, it's going to break out, and it'll break out about 5 points. This is going to be a pretty significant move here in STM. I wish I could give you more on a direction, but I can't. I have no idea which way it's going to go. But if you are someone that likes the triangles, we do them a very unique way at Evo Trader, something that I discovered long time ago on the delta gamma relationship. Don't follow the one strike out of the money rules on the strangles. We do them differently to get the best delta gamma. Made a new word there, gamma. The best delta gamma acceleration out of the breakout. But keep an eye on that one. If you're not familiar with the strangles, then wait for a breakout of this triangle and trade that direction, because it should have some follow through. Something pretty significant going to happen there. That's a good one. Good on you for asking about that one.
Agreed. Let's go to TTD for Clive.
Trade desk. See what that's looking like. And whew, gosh, that was nasty. We do have the time strategy, which gives us scores on the likelihood of staying. These boundaries are a 1 standard deviation channel after a big drop. That's how it's set up. But the score was only 61%. So it wasn't high enough to do anything. Again, you want 75 or above. You stay away from these, and that's why. It didn't stay in the standard deviation boundary range. It broke lower. It's trying to hold here, but it's a little early because it gotten a little bit from the 10-day moving average, not too much, but you can see the sideways move has allowed it to catch up a bit. Can this hold here and bounce? We're going to have to wait and see. Let's condense the chart a little bit and see where the next level of support might be here. It's in no man's land. So it broke this. And what I mean by that is that it's in between a support resistance level. So the support was in here. You can see those few days that it tried to hold, and it broke below it. So this is one where you've heard the expression, don't try to catch a falling knife. That's what's happening here. We just have to let it tell us where the bottom is and not try to guess. I'm a big proponent. I know a lot of people in the world of Elliott Wave say don't trade the Wave 3 because it's too hard to figure out where it's going to go. But we all agree in the Elliott Wave land that the Wave 3 is the strongest of all waves. So I've always thought, why do we want to avoid that one? So I like it when there's a zigzag within the Wave 3, but we don't have that here. So we don't have a zigzag to give us a potential price target. So we need to let the market tell us. So this one is just on the watch list and wait until it tells us. The first signal would be getting back above this 10-day moving average. And then the next one would be getting back above support here at 65. So I wouldn't want to go long here until we're back above 65 because we could go lower on this. Just no way to know where it's going to go. The exact opposite of breaking above resistance and having no more resistance, that clean air racing analogy we just went through. Same thing, but to the downside. So moving in reverse, if you will.
Thanks, Rob. And just real quickly, I do want to remind everyone to take advantage of registering for the AI Fusion event. I'm going to send that link into the chat one last time for anyone that might have missed it. We look forward to seeing you all there. This next question is going back to the SBY, which you covered in great detail, and we still have a number of outstanding questions. So maybe just a quick review or quick summary, rather, for your answer. SBY daily is not an Elliott wave, but on a weekly chart, it is on leg 4 in a downward wave. Shouldn't this give a good indication of direction? That's from Michael.
Let's take a look at the weekly chart here. And I did show you how you could change it to 100 bars and get a signal on the daily chart. So you're not analyzing quite as much data, just focusing more on the shorter term, which I think makes sense because when you look at moving averages, I like exponential moving averages because exponential moving averages weight what's happened recently more than what's gone in the past. In other words, if you have a 50-day moving average, if it's a simple moving average, every day over those 50 days is weighted exactly the same. If you have a 50-day exponential moving average, it would take what's happened recently out of that 50-day time frame and weight that higher than it would what's occurred 50 days ago, which I think makes sense. And so that's why I look at that. But on the wave 4 point here on the weekly chart, we have labeled the 4 because we hit that 23.6% fib level that I talked about lately. We broke below the 50-day moving average, tried to get back above it today. Looks like we're going to try to close right on it. Again, things could change tomorrow if I don't expect it, but if the Fed were to say something unexpected, I think they're just going to be status quo tomorrow, but the Fed's going to do what the Fed's going to do. I feel like we probably need to come down and test this level, and that's getting in that 540 level that I showed you on the daily chart. So even though we get a little bit of a bounce on the daily chart, I think this wave 4 on the weekly chart comes down, and then they would kind of agree. You would get down this level, maybe closer to 38.2 on the weekly chart, and then you get down to that 540 level on the daily chart. So good question. It always makes sense to look at longer term time frames, follow the higher degree was the phrase that Elliott used. Always taking a look at the next higher time frame is a good way to get a little bit of an indication on the slightly longer term. So switching it to 100 bars gives you more of an indication on the shorter term. Going to the next higher time frame, a la weekly chart, gives you an idea on the longer term. So yeah, good question.
Over to RUM for Manuel.
So I really like doing TradeFinder, man. We have such a good group now. You guys ask such good questions, educated questions.
That's RUM. Sorry, RUM as in Maverick.
How could you mess that up?
My apologies.
Did you not watch Pirates of the Caribbean when you were growing up? Well, where's the rum? What happened to the rum? Captain Jack. So Rumble down here, y'all know what Rumble is, I'm sure. And maybe we're going to start looking there a little bit more. I don't know, but it's trying to hold $8. The break below 10 was significant. You've heard me talk about this before. For those of you that are newer, the important levels from an institutional standpoint are 5 or 10. So if a stock is trading above $10, any investment company that has growth as their investment objective can own a stock above $10. If you drop below $10, you have to be registered as aggressive growth. So that's not as many mutual funds, et cetera, investment type companies that can own it. So when you break below 10, there's a period of time where if it stays below 10, those that are registered as growth have to sell because they're not allowed to own it anymore. And then you come down to 5. You can see where that was resistance. It broke above it, and then bam, there's where the volume came in, as clearly some investment companies wanted to push it above 10. It came down and tested it. It was holding, but they've probably had to sell. I want to look at the volume real quick here and see if they've bailed yet. Not really. You can see that these bars on the bottom aren't that big yet. I used to know the exact time frame, but they change it so often. I don't remember exactly what it is now. I need to look that up. But there'll be a point where if it doesn't start to mount a move back up towards 10, that some investment companies that own it, I don't know how heavily owned this is by investment companies. That matters because if not many own it, then this 5 and 10 thing doesn't carry nearly as much weight. But if it's a heavily owned stock by institutions, then the 5 and 10 are something you really want to pay attention to. But right now, it needs to hold 5. If it breaks below that, then it's got a problem. You can see this buying that occurred back here, and if it breaks 5, you're going to see a bar like that that's red on selling to the downside. So you got to watch that $5 level. It needs to hold that. We did fill this gap up here But for me, I just couldn't get interested in this unless it's able to find a way back above 10. If the economy is going to weaken and stuff, maybe people start doing other things and it can catch a bid. But for now, at 5 is the level you got to watch. It's got to hold that level. Let's do one or two more, Zach, and then we'll move into posting the idea for the week.
All right, I'll let you with two more. NAK for Manuel as well.
NAK. Okay.
Yes, sir.
Northern Dynasty Minerals. Not too familiar with the company. You can see it's less than $1 stock. So it's been on the pink sheets. Obviously, moving to what exchange was this on? Take this look at this again. NAK. NASDAQ. Okay. So able to get to the exchanges. We're forming a pretty nice ascending triangle. Manuel, is that who asked this? We've got a nice ascending triangle forming here. You can see clearly the resistance up there around 75 cents. And this higher lows here off of about 55 cents. So you're going to get a breakout move in this stock. Remember, an ascending triangle doesn't mean an upward breakout any more than a descending triangle means a downside breakout. You do have this wave 5 formed here, but as I said, you can't assume we're in wave 5. The wave 5 target's up at 90 cents, but it's got to break to the upside out of this triangle yet. So you're not going to be able to do a strangle on this. You're just going to have to wait and see what direction it breaks out. But from 55 to 75, it's going to be a 20-cent move coming on NAK. So that could probably work out really well for you with the low cost there. But at this point, it's the Missouri thing. Show me which way are we going. But I wouldn't want to speculate on this at all. Again, a triangle can break either direction, but if it starts to break out of this upside, I think you can catch it up to 90 cents.
Thanks, Rob. And final question before heading over to the case study consideration will be from Alex. If the market's sending caution tale, why is copper ripping? Isn't Dr. Copper a tell of the economy?
It has been. The reason copper is ripping is because of the tariff stuff and less importation of copper, or whatever we import is going to cost more. So that's what's going on with Dr. Copper. But you're right. It got the name Dr. Copper because it was historically a good sign of the economy. It's not right now. It's moving for different reasons. The economy is actually weakening. Again, it remains to be seen whether we go into the classic definition of a recession or not. I'm sure you're feeling, the effects of a weakening economy. You can see it in the job market, the home builders market, et cetera. Obviously, we just saw the number on new car sales dropping off dramatically. Delta Airlines came out and said there's not nearly as much domestic travel as there was. That's dropped off dramatically. There's signs of a weakening economy everywhere. So the reason that copper's moving is kind of in concert with gold and silver, not so much from the economic standpoint. But you're right. Dr. Copper came from, historically, it was a good indicator, but that's not the reason it's moving right now. So another great, man, every single question was outstanding today. Awesome job, everybody. Great stocks to look at. Really enjoyed doing this TradeFinder class. All right, Zach, we're going to do SPY, understanding that things could move differently tomorrow, depending on what happens with the Fed announcement. But we saw Michael asked that question on the weekly chart. I do think we have to move lower in the market before we move higher. So we're gonna do the SPY down to 540. Is what our case study consideration for today is going to be. So that will be an idea, Zach. It's not an AI trade, but it is following pretty general Elliott Wave rules, in addition to basic support and resistance rules as well.
Very good. Sounds like a plan. Let's get right over into it. And I will post this idea on the platform for everyone to come and interact on. Everyone can see my screen there. We're at a menu view, a jumping off point of the platform dashboard. Go over here to this light bulb here to see all of the growing ideas from our community. We'll go up here to new ideas to create a new idea. As Rob said, this is going to be an official idea. So this could be equated to if you're executing this trade with your brokerage in paper trading. And all of the data will be real time, just as it would be if there was real capital on risk, or real capital in regards to risk being on the line versus just real paper trading where you don't have that same risk. So sorry, just generating the title there. Let's go over to the symbol for SPY. Target price of 540. Is that correct, Rob?
That's correct.
And what's the time frame we're looking at for that?
3 months.
3 months. Sounds like a plan. We'll click that, and I'll come back here. We'll both make this very pretty here in just a moment. And I'll go ahead and post the idea now, so it'll be officially there and able to be interacted with. We encourage you to come in and interact whether you agree or disagree with the idea. As I've said before in the past, and will continue to say, opposing opinions is what makes markets. There'd be no transaction if everyone agreed with the trade. There always has to be an opinion on both sides, both buying and selling. So we appreciate any comments that you may have around it, your thoughts. Just add supporting evidence, and obviously be mindful and courteous to those that are interacting with you on the platform. But other than that, it's up there. So we hope to see you there. We hope to see you at the Wednesday event for the AI Fusion. Again, don't forget to miss out on that. I'll send the link in the chat one last time, and I'll pass back over to you, Rob, to add final thoughts.
Yeah, I wanted to reiterate what you said about I get notifications every time somebody posts something on the social media platform. I think it's fantastic, and people have been very respectful. And it's always great to post an idea, and even if you see somebody that has an opposing idea to you, know that that's what makes markets. If we didn't have opposing ideas, there wouldn't be any markets. So keep a differing opinion respectable, as you said, and we can have a great platform there of sharing ideas. And I think it's growing, and I just can't wait to see how big it gets in the future. It's awesome. And this group here, the founders, I guess, of the social media platform that come here to TradeFinder, just is an amazing group. You guys are awesome. Love doing this show each and every week. Thanks again for your attention this week. And again, reiterate what Zach said about the AI Fusion event tomorrow. We will have the results of the Fed meeting to talk about at the beginning of that, so we can chat about that as well. So have a great rest of your afternoon. We'll watch the Fed's comments at 2 p.m. and we'll see you hopefully at 8 p.m. tomorrow night. Thanks, everybody. Look forward to talking again soon. Take care.